Hello, how are you? Hopefully you are doing well. In today's video, I will cover the Ford Motor Company. The ticker name is F. And in this video, as you can see, if you are new to my channel, so just to let you know, so I will use the couple of model, for example, profit model, enterprise model, free cash flow model, and come up with the intrinsic value of the stock. So, and not only the intrinsic value, but we'll see okay how the overall company is doing, what its debt ratios, how it's behaving, or the management is taking the proper decisions in terms of the coronavirus, and then make the final opinion whether this stock is good for the long-term investment perspective or not. So in my channel, I also take the opinion from the YouTubers or the investors who subscribe or put the comments under the video. So if you want, please comment it and I'll take it forward. So without further delay, let's get started. So I'll hide myself. Okay, so let's go directly to the financials and the first model, which is the net profit model. So here in this net profit model, I have taken the 10 years of data from 2019 and 10K annual statements to December 2019. So as you can see, I have the revenue and the net profit and year over year net profit change. So the net profit margin, as if you can see, it was very good in 2011, is around 208%, but then it dropped and then it come back, dropped and then it come back. So it's, if I see overall in the 10 year is the CAGR is only a little bit less of 2%, right? So it means overall it's like a per 2 years annual growth. But if I take the recent 5 years of the revenue growth, which is only not even 1%. So this means that from the last 5 years, the company is doing very badly in terms of, or you can say not able to grow the revenue, which we can clearly see for sure. If the top line is not growing, the bottom line shows that as well. In the last 10 years, which is a very big decade, the CAGR is almost minus 40%, and in the last 5 year, it's double, it's a negative almost. You can see 40 to, actually it's not that double, but it's 60, almost 64% negative, right? So this means company is doing very, very bad in terms of pretty unable to grow its revenue. So what I have done here, so I have taken the average net profit for this company, which is for the last 10 years, and then reduce the net profit, which is for the last 10 years, which is minus 40%. So I'm reducing to see if, okay, for the next 10 years, they might grow at the economic range, right? At the rate of 2%. So you can see I'm very 4%, 2%. So just doing the interpolation and reducing this, the negativity of the profit. And then at the end, I assume that the company will grow at this rate. So when I does that one, right, so this is my short term very negative growth, and then the long term it's grow as per with the economy. So that's what my assumption on this model. My required return is 10%. So any company which I'll take, I expect it does at least give me the 10% return. If it's not giving me 10% return, I'll better invest in S&P 500, which is much diversified and at least giving me good returns on historical average, right? So that's it. So at the moment, the company has 3.9 billion, 3.96 billion share outstanding. So here 1 to 10, I basically reducing the growth to 2% and then taking the present value for this natural profit, right? So that's how I'm doing. So once I did this math, I got the market cap in millions. I divide by the number of share, and then I'll got my first value. So this value, when I got it, it's only $3.65, which makes sense because if the company won't do well, we are basically reducing its value, right? So okay, so that's what it is. Okay, so let's go to the next model, which is the enterprise value model. So enterprise value model, again, I have pre-computed this for the last 10 years using the financial data. And if you can see, so this is my enterprise value. So it's $101 billion to $273.64 billion. So it's grow pretty good in the last 10 years. It's 10.46%. And in the last 5 years, it's a little bit increase, which is 10.90%. So what it says, basically, if you want to go and buy the company in 2010, you have to pay $101 billion almost, right? But now in 2019, you have to pay for $273 billion because these are in millions, right? So that's the value of the company. Similarly, on the next row is in EBITDA. EBITDA is the operating income plus interest and depreciations. So this is, again, I have pre-computed to save time because there is so much information here in the slide, and these are pretty easy to do, I think. So the main focus here is to come up with the stock value rather than to impress anybody on the simple calculation. Okay, so if I do that, so this is a very good matrix to show. So if you can see the enterprise value over the EBITDA, which was very good in 2010-5, right? So this means if you buy the company, you can get its money back within 5 years, right? So that much revenue company is generating. But over the years, it's got worse, and now it's 30, which is way, way bad, right? So 30 times. So this means it takes 30 years to generate that much of the income. Now on the next row, we can also see the total debt. So total debt is again telling us the story. So it's grown significantly. And if you can see that the debt over EBITDA ratios is also increased, which makes sense because our bottom line is not increased that much, which is EBITDA, but our top line debt is increased a lot, which we can see here that it's grown over 4%, right? The debt ratios. Okay, so my EBITDA for the 10 years again is telling the same story because as you can see, if the revenue doesn't grow, how come I have, and to run up these companies required a huge operating cost, right? So my EBITDA that's why showing negative as well. So here I'm also did the same. I have taken the average EBITDA for the last 10 years and then average debt and average cash flow for the last 10 years. And I'm reducing this EBITDA growth rate from -7.5 to 2%. So, right. So then I'm reducing the growth rate and assuming that the company will grow. But here I'm taking the 6.5 as a terminal value. So I am assume that after 10 years, I'll just sell this company at 6.5 of its EBITDA to come up with that enterprise value, which is $70 billion. So if I just discount that to the 10% rate, I get that the value of in today's term by the $10 billion, right? And here I'm reducing it by the cash flows, which I'm discounting. Sorry, I sum the cash flow, and basically I'm doing the enterprise value, right? So I have to reduce the debt, which is 128 billion, and add any average cash. So that's why you see this number is lower than even some of these numbers, if somebody wondering why it is so. Then again, once I have this enterprise value, my forecasted or using by the model, I divide it by the number of share outstanding, and using the EBITDA model, I get my second number, which is even further lower. You can see this is 2.60, and it's reflect the story of the enterprise value model, right? So that's why we'll take different models. So far from the net profit model and the enterprise model, the price is coming very down. Okay, let's see the third model, which is the free cash flow model. From the free cash flow models, again, I have taken the 10-year data. I have taken the operating cash flow and then reduced the capital expenditures. right, from that operating cash flow to come up with these free cash flows. This is a simple model to come. So the people, okay, so that's how my for 10 years of free cash flow is it. As you can see here, my free cash flow has grown at the rate of 3.08 CAGR for 10 years and 2.20% growth rate, which is not very significant, but maybe these are more like a mature companies, and it's very disruption industry, right? The car auto manufacturing by Tesla and new EV models. So people are going and maybe and the American car. So I'm not going that route, but let's see that number. So I have taken the 10-year growth rate as 3.08 and then 2 year as a long-term growth rate. Here I'm taking the 3 as a terminal value. So this average cash flow I am reducing, take the 3% growth rate, but then again I've been pretty very conservative and then reducing it to 2% using the interpolation. So again the simple, then I just project the free cash flow by using this growth rate here, and then do the discounted using again the same 10%. So my market cap in million is $57 billion using the free cash flow. This is a little bit higher. Why? Because the company is doing good enough, although the net income and the EBITDA is negative, but the company's the EBITDA projection is negative, but the company is good enough to have the significant amount of free cash flow, which we can see clearly in this model, right? So, but I've been pretty conservative, so I only give 3 because I know the net profit and EBITDA is negative. So if I want to sell this company after 10 years, then using based on this free cash flows, then I'll use the 3 times of its free cash flows, right? So that's how I get this $29 billion. Okay, so using this model, if I divide by again the number of shares, so I'll get my intrinsic value of $14, which is much better than as compared to the last. So now with 3 different model, I have my price. I got the price. So now I need my final price to see, okay, what's my value of it. If I so this in this sheet, I take the net profit model, EV model and FCFF model, and give the almost equal weight to all of these. So one equal weight and then sum it up. So my price is coming as $7.04. And if I compare with the market price, so market price is going around the same right now, 6.9. So not much difference there. So from this perspective, I think the company is fairly valued right now, right? Now the next question is, okay, how much I'd like to see how much the debt company is and what company is doing in terms of the COVID-19. So that will much reflect, right? So let's see that. Before that, I really quickly show you the top return and some of the liquidity as well, because liquidity is very important to make the decisions. If the company doesn't have much liquidity, then it's pretty much gone. So if I see from the top return perspective, which is the return on investment capital, equity and assets, here the return on investment capital is, you can see, is on the single digit, which is very poor, right? Which is clearly reflected. Now it makes sense, because if the revenues and net incomes is not coming, and so how come the return on investment capital we can see? So it's pretty close to 0. All 3 returns, basically it's very close to 0, is 0.1, 0.2. So it's pretty bad. Okay, let me quickly go to I won't go to the PRAT model. I didn't see any significantly which I like to share. But on the liquidity ratio, so on the liquidity ratio, the company has enough liquidity, seems like, right? The company is doing enough to have, because it's over 1, both the current ratio and the quick ratio. So from this perspective, it is good. So this means the management is doing pretty good job in terms of preserving the cash to handle the short-term liquidity crisis, right? So that's I like about this. So I'll give the check mark on this one. So let's see its quarterly statement and the risk, and then we'll make the opinion on these stocks. Okay, on the recent quarterly statement, we have seen that this the company actually is pretty although it's a summer time, but the room has quite good AC on, so that's why I'm wearing this. Okay, so let's see that. So if you can see on the left side is 2019, usually it's the other way, and this is 2020, right? The first 3 quarters is comparison. The company has a significant reduction in terms of the selling, right? So you can see this 37 billion to 31 billion dollars, so almost $6 billion, because these are in million, right? Loss, which this is the top revenue and the cost of sales. So the net loss basically it's almost $2 billion, whereas the same time in the last quarter the company was making profit of $1.14 billion. So that's why on the per share basis the quarterly it's reduced 50 cents, right? So that's clearly mentioned here. Okay, so let's see some of the risk, and I think you want to see these risks for sure before making any final decision. So here I have taken the risk from their 10Q. So first risk, okay, so this is what they say: the company has announced to suspension of the regular quarterly dividend and share repurchase. The company is not doing any share purchase, or they are not giving any dividend, so which is bad. So right, from the investment perspective, because maybe the companies need to have enough cash to preserve liquidity. Another bad news on the company is all of their employees are working remotely except from China, right? So that's, you can see from here, in nearly all our non-production employees, okay, these are non-production employees, right? General action taken, right? We are idled our manufacturer. See, they are not doing any manufacturing. Say we are idle our manufacturing operation in region around the world other than China. So other than China, everywhere this production is stopped. So for sure, if they have no production, how come the machinery is down? How come they? The third big point which I like to share is they have raised the heavy amount of debt. You see, to further enhance our liquidity on the note, we have issued $8 billion of debt. This is US dollar in 3 years, 5 year and 10 year of public unsecured debt. So these unsecured debt means these are basically provided for a low credit quality company. So for that they have to raise higher interest. Just to give more shed light on it, so I have taken the note from 21, which is saying they are paying 8.5%, 9%. So on this unsecured debt, they need to pay 8.5% debt interest, which is on 3.5 billion for 3-year terms. Another 3.5 billion, which is for 5 years note. They need to pay 9% interest, and then things get worse. On 10 years unsecured note for $1 billion, they have to pay 9.625 per interest. So look from this perspective, right? So what do you think now? So if company is have to first of all have to stop their machinery to produce the car. Second, they have to raise a lot of money in terms of higher, like over 9%. So how can we expect company to generate 10% return, right? So I think for me, I'll stay away for these stocks, although the company has the price or the pricing in the single digit, $7 or something going on the market. But my expectation is in future it's might come more down. So let me know what you think. Do you think you're okay, or do you think it's still a buy for you? Or and also if you want me to cover any other stocks in this channel, so please do put a comment. And I really appreciate if you're new to this channel, kindly subscribe and like this video. And last but not least, thank you very much to being with me and watching this video and supporting the channel. Okay, see you soon in the next video. Bye for now.